welcome to the Day Trade to Win webinar of how to trade certain trade management ideas that will definitely help you. Thanks, Mike. Thanks, John. So just a quick sound check here before we begin, making sure everyone can hear me. Now, very important before I begin, a disclaimer on trading futures, Forex, options, stocks. Please remember that trading is risky. Don't trade with funds you can't afford to lose. If you have any questions, please email me or visit DayTradeToWin.com for the risk disclosure. As well, you can talk to your broker. Obviously, we don't want to trade with any type of rent money or funds we can't afford to lose, and trading is risky. So just wanted to make sure everyone's aware of the risks when it comes to trading. Now, with the markets, we may look at the E-mini S&P, we may look at stocks, we may look at options and Forex, but really what you're looking at is the type of trading that you do shouldn't really matter as long as you understand the risk that's involved and the profit, the stop, the rules that's involved. And if there's ever a situation where there's too much risk, then please don't trade and don't place the trade. You don't have to trade every single method and market. Keep it simple. So if you're interested in looking at, especially for the new traders, some of you may be new here, some of you may be seasoned traders. If you're looking at obtaining a simulator, well, you can start learning, no cost. Just download the simulator, access the live data, and you'll be able to start practicing. So that way you'll save money. You don't have to open up a broker's account, and you will at least get your foot in the door and start asking questions on how trading works. It's not for everyone, obviously. Hey, Ray, good morning. We also have a few resources in case you're new to Day Trade to Win. We have a blog that has the latest information, news events, videos, the actual webinars that I record are also placed here in the blog. So there's a great resource here on the Day Trade to Win blog, especially the tutorials if you're ever wondering how to roll over. So I do have and I do offer some helpful hints here for traders. As well, if you look at the courses and software, there's some free downloads. So be sure to check out the free downloads, especially if you're looking for the news indicator for NinjaTrader, or if you're a TradeStation user, you can download the bar timer or the online news calendar, which is a web page I created. So there's a lot of resources here on the page. If you have any questions, you can always check it out and email me. So there's lots of videos here as well, testimonial videos. And these are real people, by the way. These are all real. And some trading videos as well here. So the website is very informative. Now, when I look at here a market like the E-mini S&P, my goal is to show you and explain to you how to best take advantage of the movement, not necessarily adding indicators and adding different types of optimized values, for example. Hey, Carl, good morning. So really what I want to do is, first of all, understand that the market itself is just candles and pricing moving up and down. When you look at actually getting filled and actually taking a profit and stop, formulate rules. So one of the ideas here on trade management is having rules before you actually enter into the trade. I'll show you a couple of trades. I'll show you the Atlas line. I think somebody was asking for it, Dean. I'm not sure. I think it was Dean. Or the at the open method. The idea is to have some formula rules before you enter, because if you have rules before you enter, you already understand the target, the stop, what's going to happen if the target and the stop don't work, the risk involved. I mean, there's a lot of things that you should know ahead of time before you actually enter into the market. So the first thing I want everyone to do is very simply adding, and if you've watched any of my videos, I'm a big proponent of adding the ATR, the average true range down here. And the average true range with a setting of 4 is what I recommend, allows me to always understand if the market is slow, if the market is fast, if the market is not tradable, or more important, I think, than any of those things is the expectation as a target and a stop. So I'll give you a perfect example. Here we are, right as the market opens. I have a 5-minute chart. Really, what can I expect from what you're seeing? Well, some of you may say, I want 2 points or 3 points of target. Some of you may say, I only want a small stop of a point, or I want to have a 3-point stop. I think if you look at the current conditions that the ATR is actually suggesting to you is possible, currently, I would only suggest to you that 3 ticks, less than a point, is what the market has been doing the last 4 candles, and really what you can expect moving forward into the future, the next 4 candles. Okay? Sure, Carl, I'll be happy to show you the ATO for today. We'll pull it up and we'll see what happens. So when you look at taking a profit or a stop, really what I want to do is I want to say, can I make the target, or is it just something that I assume will happen? So never assume that the market is going to move a certain distance unless we can relate it to something. I use the ATR, and I teach this both in the classes with the individual courses or the mentorship, that looking at the ATR is very important because I can assume the 3 ticks is most likely what it will achieve. Now, when you're looking at getting filled, there's a few stops and targets, ways that you can enter and exit. It seems, especially for the new traders, very complicated to understand the type of orders that exist. So let me bring up here my DOM, and I'm going to briefly explain to you the reason for each order, why you should be using the order as a market, as a stop, as a market if touched, or as a limit, or even a stop with a limit. So there's a whole variety of orders that you can place and which should be right for the situation. So let me bring here up a DOM, and the DOM here is how I prefer to trade. Now you can definitely use the chart trader. I don't have anything against the chart trader. It's just a preference. When I first started trading, the DOM was, or the price ladder, or the matrix, however you want to refer to this. There's different ways to refer to this. But the price ladder is how most of the traders for years back have looked at the market. And understanding that these values here and these values here are orders that are trying to be filled. But I don't want everyone to believe that these orders are actually real orders wanting to be filled, because this is, as electronic market goes, can be changed very easily. So I call this phantom orders. These orders here, even though you may see 1100, 1500, 1300, 1200, they can be changed very easily on the fly. So I want you to think about what you're seeing and not say this is very strong resistance. How can the market go through these prices? Or this is very strong support. How can the market absorb all of these buyers or all these sellers? Because they're very easily moved and changed at any second. So if I place here a limit order, then if I'm added here to the board, if I decide to move this order at any point in time, this will change. And this could happen, and it does happen every second. And what you'll see is, let's say, a large number here, and as soon as the price hits that value, the order is changed or the order is canceled. And so you're going to see some type of, I would say, manipulation when it comes to these orders and the belief that the resistance will hold or the support will hold, because there's so large amount of contracts waiting to be filled. So don't believe that these orders are real. And there's electronic programs that exist that they're constantly putting on and taking off, putting on and taking off. Really, you can't believe that these orders are true traders wanting to be filled. So the first thing is, don't believe the orders. The second thing is, as soon as the market opens, usually within the first 5 or 10 minutes, we make the mistake of thinking that this is a good opportunity to trade. And I have to say, under normal circumstances, the ATR and the volatility is higher right as the market opens. But there's a caveat. There's something we have to consider. We have to consider what happens right as the bell rings. So living in Eastern Standard Time, which is the New York time for those of you who are international, here at exactly 9:30 and 9:35, we have this bell ring and the market begins to trade. And right at that moment, we can call that the day session, the pit session. What we have here is a battle between the buyers and the sellers. And you have stop orders getting hit from overnight. You have buy orders coming in as soon as the bell rings. There's electronic trading that happens. And there is a huge swing that happens as the market begins trading right as the bell rings. And I would have to say this is just for, it's not just for the E-mini or for the Dow or for the NASDAQ. You can look at this idea of a battle for the buyers and the sellers as soon as the market of your choice, whether it be crude oil, a Forex, a stock, an ETF, it's the same thing. So don't be rushed into placing a trade right within the first 5 minutes. If you see that there's a big swing that's happening up or down, you're going to get caught up with this. So if you have an order that's um, going long, and maybe the market will go up and will go long, you have to remember that there's going to be buyers that are trying to get filled right as the bell rings, and there's going to be sellers that are actually trying to get out of a position or get into a position as well. So there's a battle that will flip-flop and make a type of whipsaw, which will be a problem, especially if you have a small stop. So my recommendation is always wait 5-10 minutes because there could be a huge swing up or down right as the bell rings, and that would be across all markets, not just what you're seeing here on the E-mini S&P 500, but across all markets. Now, if you have any questions, this is a live event. You can ask your questions here in the room. I'll take a look at the room and answer your questions as I see them. This is not a recorded session. It's a live session. So just be careful as soon as the market swings either up or down right at the beginning of the day. Don't just assume that because this is a large red candle or green candle that's going to continue. It may not. It may just be the all the orders trying to get in and all the orders trying to get out. When I also look at the type of orders, limit orders, which is left click here above to sell or left click below on the buy side, it's always a retracement. So a limit order is used as a target, as an entry, as a way to enter without any type of slippage. Now, slippage is not really a problem unless the market is very volatile or the type of market that you're looking at is very slow and illiquid. The E-mini S&P has a lot of liquidity. You're not going to have more than one tick of slippage. A limit order, left click like this. Let me just put this here to 1.
Order pending.
So when the market retraces back, I'm short at this price or better. So the definition of a limit order is I want this price or better, which leads to another problem. Trade management is not just exiting and it's not just entering. It's trying to get filled at the price you want without a lot of slippage. Limit orders are the best way to do that, but you may not get filled when it hits your target or when it hits your stop. That's a problem. That's a big problem, especially when the market has been a little bit slower. The market that you're looking at is a little bit slower. So it could touch this price and touch it and touch it and touch it. And the way that electronic markets, especially with the futures market, work as a first come, first serve, you're in a line, you're in a queue, you have a ticket. The ticket says that you're number 900 or you're number 800 or you're number 1377. You're waiting to be filled when your order comes up. And if you constantly move your limit orders either up or down, you're now being placed at the back of the line. And this is very easy to do, first of all, and we always want maybe a better price or we want a larger target. So if you're looking for this price as an entry as a seller, and you say, you know what, maybe I can get a better price, now you're at the back of the line. And if you decide to put it back where you initially had it, you're also now at the back of the line where you were previously, but now you're worse off. So be very careful not to move your limit orders until really you're ready to get in or get out or really force a fill, which as soon as you place this limit order or move
Order
it
filled.
below from where it's trading, you're going to get filled. Okay. So be very careful not to move these limit orders around because you're putting yourself at the back of the line.
Order
A
filled.
market if touched order, I get a lot of questions on this, is basically saying when the market hits
Order pending.
this price, I want to sell it at whatever price you can get me in. So a market if touched is placed exactly like a limit order. It's a retracement, either up or a retracement down like this.
Order pending.
So you're going long, but as soon as it touches this price, it doesn't matter if you're the last person in line, the first person in line, it'll just convert itself into a market order. Well, that's good and that's bad. The good thing about it is you're guaranteed to get filled. So not to worry if one contract here touches this price and only one contract is filled and then it bounces off, maybe double top or hits resistance, you're in or you're out. You don't have to worry about getting left out of this price. You may get a tick of slippage, you may get the exact price, you may get a better price, but you're always going to get into the market with a market if touched. That's a good thing. Now, the only bad thing I can say about a market if touched order is that slippage could be a tick, could be two ticks, especially if the market is, during a news event, it's volatile. You're just going to get some slippage with a market if touched order. I would say don't count on more than a tick under normal circumstances. Sometimes you can get the exact price or better price. That's the only thing I can say that's against you with a market if touched order. But you should be using a limit order or a market if touched order as entries, especially if you know exactly what you want. You want exact price. Most of what I teach uses exact pricing, and therefore you are always looking for a specific price, market if touched, and a limit. Now, a stop order is a little different. A stop order
Order canceled.
uses this idea that you're moving in the same direction as the market is up or down, like a trend. The market's going, let's say, up and up and up and up and up, and you don't want to sell it. You want to buy it as the market is moving north, going up. Middle mouse button, you press it down.
Order
This is a
pending.
stop order. Again, a stop order could be an exit. Most of you know a stop order as a loss or a protective loss, but it's also an opportunity to enter. So if I placed here this stop order, it means I want the market to come up and fill me long. Or if I placed this stop order,
Order pending.
I want the market to come down and fill me. So I'll be short as an entry or I'll be long as an entry. So I'm getting into the market on a stop. The stop order also works like a market. As soon as it touches, it converts itself into a market order. So that means that you could get a tick of slippage, you could get the exact price, you can get a better price. So don't count on a better price all the time. Always count on the worst case scenario, which is possibly a tick of slippage. But you'll get in or you'll get out of the market. So let me know if anyone has any questions so far on stop orders, middle mouse button, or the limit order,
Order canceled.
left click,
Order pending.
or a market if touched, which you hold down the control key and also left click.
Order
Is
pending.
everybody okay with that? So these are different type of orders that are placed. Last is a stop with a limit. And a stop with a
Order
limit
canceled.
is basically saying, well, if the market hits my stop, I want to limit the amount of slippage. NinjaTrader by default uses a stop with a limit that looks like this. And this does not mean amount of contracts, it means how many ticks of slippage you're willing to give up when it touches this price. If I have this at 0, when the market comes down and touches 25.46 quarter, you will get no slippage and you may not get filled at the same time. So when it touches this price, you can say, this is the price I want, or don't fill me. Or you could say, I want 1 tick of slippage, which means I want this price or this price. Or let's say 2 ticks of slippage. So you're giving yourself some leeway to get filled anywhere between 46.25 and 45.75. So this is a way to make sure you get into the trade, but also limit the amount of slippage. Even if you place this as a negative, this is interesting because placing it as a negative, once it hits this price, you're looking at a better price to get filled. So sometimes this may be an option as well, but it doesn't mean you'll always get filled. So when you look at this price as a stop with a limit, just think about limiting the amount of slippage once it hits this price. Now, I have this configured on my end to default middle mouse button as a stop.
Order pending.
If I'm really going to use this order, I want to get in or I want to get out. If you have it as a stop with a limit, which you should, NinjaTrader defaults to
Order
this
canceled.
stop with a limit, you can alternate between the two by holding down the control key and then hitting down the middle mouse button, the wheel, or you can change the default settings. If you right click here and you choose properties, it'll give you a list of properties to change all the defaulted settings as well. So that's a quick way to alternate between a regular stop or a stop with limit. Questions, anyone? Everyone's okay? I don't use time and sales, Armando, for what I do or what I teach or Fibonacci's or indicators. I don't use any of that. Time of sales is great to look at, but sometimes hard to interpret, and really not something that I would bother with. I rather focus on the candles. So you go to new, you go to time and sales over here, and a window will pop up. It's actually on another monitor here, and what you're seeing is actual orders. You see a lot of ones, but don't be fooled when you see a 10 or 29. It doesn't necessarily mean the market's going to continue. This is great to look at, but I think it's irrelevant in the bigger scheme of things. Now, 30 years ago, time and sales, fantastic, because you have to call your broker. Your broker would have to call the floor. The floor would initiate the trade. He would get back to your broker. Your broker would call you back. It took time. So the orders 30 years ago, reading the tape, was something viable. Nowadays, electronic trading, it's not something that we should be focused on. Okay, so what happens if your target isn't hit after you get filled and it touches and touches and touches and you're not filled? What do we do, or how do we handle that, or you know managing the trade in a certain way? Well, I think that when managing a trade, it's not as easy as everyone makes it out to be. If I was going to, for example, let me just bring up here the Trade Scalper. So the Trade Scalper here, one of the methods, is looking at the market moving up and down and taking these very small targets, typically 2, 3 ticks under normal circumstances. When the market hits your target, if it hits your target and it hits it and it hits it and you're not filled, immediately move your stop or move your target to a break-even trade or even a I would say a 1 tick or a 1 tick loss, +1 or -1. Now the reason why I want to do that is to limit the trade becoming a complete loser. Because if it hit your target, consider the fact that it may not hit it a second time, or hit it a third time, or hit it a fourth time. So if you were about to go, for example, give you an example. Let's say that this here indicates go long. And if this was the target and it hit the target and immediately the very next minute market came down, this may have been the only opportunity at this price to get your fill. So don't let a trade become a losing trade after it hits your target. So trade management, the theme of this webinar is it hits your target, you're not filled, protect yourself. Now, the ATM strategy, what you see here, is a great way, and there's a lot of different platforms that offer this nowadays, but this is a great way to get yourself into the market with less mistakes. If I go long just as an example here.
Order filled.
Immediately my target and my stop is placed for me. If the market goes up and hits my target and hits it and hits it, and I'm not out of the trade and it starts to come back down, don't let this turn into a losing trade. Immediately move your stop either to where you entered or a tick below, or move the limit order below where it's trading. We can afford a tick or two ticks of loss. That's not what's going to hurt us. What really hurts us as traders are these large losses, the large losses that we can't come back from, losses that when they occur, it's very difficult to recoup and recover, or it takes a longer amount of time to do so. So if you ever have this situation, which will happen, it always happens, where it touches your target but doesn't necessarily go through it because maybe only 100 out of these 1,300 contracts get filled and it comes down to where you entered, just remember, don't let that turn into a losing trade. Please exit the trade and say, well, I lost commission and maybe I lost a tick, or maybe I got a break even trade, but I didn't lose my shirt on this trade. So that's very important. The other thing you can do is use a market if touched order, which we covered a little while ago, which says if the market hits this target, you don't have to wait in line with the limit order until your number is up. Convert it into a market, and so you're officially out. Another way you can do it besides using market if touched, if your broker doesn't offer that, would be what's called front running. Maybe you've heard of this in the past. I cover this in other videos for years now. Front running is this idea where if my target is 4 ticks and it's based off the ATR, place my target in front of the word front running, in front of what the ATR is telling me or what my target should be. I'm just making sure that once it hits this target and then goes through it, everyone at this price gets filled, as opposed to me wanting this price and I don't get filled because it didn't go through it or because my number didn't come up. So remember here, one tick in front would be considered front running. Not that you have to do that all the time, but if the market is slow or if you're holding out for this trade for hours on end and it's time to let this thing go, I would front run the trade and make sure that when it goes through the 3 ticks, I'm out instead of hoping to get the full 4. Is that clear to everyone? Front running? All right, the other thing that we could do
Order filled.
here, let me add the Atlas line just to show you what's happening here. So these are the indicators that we provide with mentorship, the ABC, and this is actually also, the ABC is also offered with the At the Open, the Atlas line, the ATO2, the multi-lines, the news indicator, the roadmap, the Trade Scalper. So I'm going to add here the Atlas line. And the Atlas line has these trades, main signal, pullback, strength, bounce, and it can be configured any way you want, but there's no optimization. When I add this here to the chart, here is the Atlas line right here. The signal to go short is 25.48, and I want to go short. Remember, I have an exact target that I want, which in this case, 1 point. That's all the market can tell me, can give me. So 1 point from 25.48 is 3 ticks. So front running would have gotten you the 3 ticks, but not the 4 ticks. I also have this idea of using multiple exit strategies, not just one target and one stop. Many traders use one target and one stop. I like to use a variety of stops to help me out in case the market doesn't go in my favor. Time, proof, and some type of catastrophic stop. Time is very important because many traders, they do not get out of a trade in a certain amount of time, which is a problem. So if you're holding on to this short Atlas line trade or ATO trade or blueprint trade or whatever type of method you're using for more than 4 or 5 candles, you're holding on for too long. Whether it's an hourly chart or a 5-minute chart or a daily chart, it's irrelevant. It's based on the time that you're using, it should be 4 candles, maybe 5 at the max. That way, you're ensured you entered for a reason and you're exiting for a reason being you didn't make your target. Proof, use some type of proof to get out of the trade, as well as a catastrophic stop. When it all goes wrong, protect yourself with some type of stop, meaning the last case scenario. So I like to use a grouping of stops to get me in, or I should say to get me out, and managing the trade while this is happening. You can't just walk away. As an example, do you see how the market here, this ATR, is indicating that it may be getting slower and slower as time progresses? Well, it also could be increasing as well. It's correct. But if the market is going slower and slower and slower, and your target, so let's say here, as an example, we'll do a short,
Order filled.
and your target here being 4 ticks, let's say that as the time progresses, maybe the second candle, the third candle, it's no longer a point and a quarter, which is always rounding down. 1.3 would be a point and a quarter. 1.2 would be 1. 0.9 would be 3 ticks or 0.75. So as you're in a trade, let's say the market is getting slower and slower. Don't forget that you're trying to take a profit based on the current conditions. If the current conditions no longer indicate that 4 ticks happens to be a possible outcome, then 3 ticks may be an outcome. So you would adjust your target based off of the ATR. So you're adapting. Traders typically don't adapt. They sometimes use the same stop and same target regardless of what the market conditions are. But you have to think about this. When the market's slow, you take slower or smaller profit and smaller stop. When the market's more volatile, same thing, a larger profit, larger stop. So if the market is slowing down, always adjust to the current conditions. That way you're ensured that as we're progressing through this trade, you're able to get, if not 6 ticks, 5 ticks, if not 5 ticks, 4 ticks. And we're not guessing, we're looking at the ATR to help us. So trade management, while you're in a trade, is often overlooked, but I want you to think about adjusting your target based on something specific like the ATR. Now, if the target is hit and it's not filled, remember, force to fill. Get out of the trade. Protect yourself. If it just misses it, and I'll give you another example here. Let's say that
Order
this
filled.
is your target 24, 25.48, and the market comes down and misses it by a tick. So it comes 1 tick in front, which is 25.48 quarter. And it comes up a little bit like this, and then it comes once again to 25.48 quarter. Right, your target here is what you're trying to achieve, but it's missing the target multiple times or multiple candles or multiple instances, just missing it by a tick. Or let's say it touches it and then it closes here, and then it tries again and this happens without actually going to your target and penetrating through it. When you see this happening, I want you to consider that holding out for that extra tick is not such a great idea. Maybe the first time it happens, you can say, I'm going to hold on to my 25.48 because that's what the target should be. I'm going to hold out for it. It doesn't come back to where you entered. It's just missing it. It comes up, tries again, and misses it. Comes again, tries again. What you're seeing is some instance of support or some instance of resistance that is blocking or stopping you from getting through that threshold. When you see this occur multiple times, just missing your target, don't be greedy. Please think about the target as a front running trade move your target one tick up so you're enforcing or making sure that you get filled without this eventually turning around and completely leaving you out of this situation. So let's say I enter short,
Order filled.
the market hits 25.48 quarter, bounces back up, hits it again, bounces back up, hits it again. 25.48 is not able to be touched or filled. Just move this up. That way, the next time it tries for 25.48 quarter, you just have a better opportunity and better chance of getting out of this position. But you shouldn't hold on to a trade for more than 4 or 5 candles, which comes out to about 20, 25 minutes with a 5-minute chart. You should definitely cut it loose. Great traders that I know never want to be wrong, and so they hold on to losing positions far greater than they should. I think it's much better to get out of a trade as soon as you realize it didn't happen. I'm able to get out with a small profit or a small loss or break even instead of having hope. Hope will destroy a trader because you're just thinking any second now, any second now, any second now, it's going to turn around, and it never does. So be very careful not to hold on to losing positions unnecessarily. You see this situation, just hitting the target that you want by a tick and missing it multiple times, instantly think to yourself, I'm going to be smart about this. I'm just going to move this up, especially if the ATR begins to get smaller and slower and slower. Is everyone comfortable with that? Does that make sense to everyone? Anyone have any questions? Now you can see these videos on YouTube and on the blog. I try to post informative and instructional videos, but you can always call me or email me if you can't find it. Now, another part of trade management is what happens during a news event or right in front of a news event, or let's say there's an FOMC. Well, I like to use a news calendar that can always tell me that there's news for the day or a news indicator, which you can download for free. It's actually right here. I'll add it here to my chart. And you can get this on the DayTradeToWin website under free software. And it'll plot, you see over here, as an indicator, the exact, and it gives you an alert, it gives you sound, it gives you all that stuff. So I know that I have to be very careful if I'm trading the crude oil, even the E-mini here at 11 o'clock today. Or if I was interested in trading the euro, this is seems to be a red or highly um, volatile news event, which may move the market. So 5 minutes before the news event comes out, if you're in a trade, just remember to get out, wait until the news happens, and then you can re-enter. You can look for a better entry. You can get out of your position. But what you don't want to do is hold a trade through a news event, because what
Order
happens
filled.
during a news event, let me show you here, is everyone is waiting for the market to release the news. It could be unemployment, housing, PPI, it could be the Fed, FOMC, minutes, meetings. What happens is as soon as that report occurs, it's better than expected. The public buys and the market goes straight up. If it's worse than expected, the market sells off, the public sells, and the market goes or maybe going down. Or what typically happens is not a straight up or a straight down move based off of a news event or a news report. What typically happens is this situation, which the market goes up and goes down in a very large range, maybe 5 points, 6 points. So it does this. So if you try to enter long, let's say here, maybe as a breakout, or you try to enter short here as a breakout, what could happen and what does happen is you may get filled long and the market may go down, stop you out, maybe fills you short, reverses and goes back up. There's this wide range that the market moves during the 5 minutes. And if you haven't experienced a news event as it pops or as it happens or as it occurs, you should definitely stay in front of your computer and see it, or maybe even market replay, which NinjaTrader offers during a news event, because you'll see that it's unpredictable. So 5 minutes before the market releases the news, or the news report is provided to the public, usually it's 10 o'clock Eastern Standard, 8:30 Eastern Standard in the morning pre-market, and then 2 or 2:30, which is the FOMC. And you'll see it on the news calendar. And I like also the Econo Day news calendar. Here, I'll give you the link to everyone. This is something I look at, especially for historical. Is something that everyone could look at as well. So this here tells me that at a certain time, I should be very cautious, wait until the news is released. If there's really not a reaction, you can continue trading. If there is a reaction, give it 5-10 minutes before jumping back in, only because this unpredictability that happens. Now, in addition, take for example, here, I'll take for example, see a couple of trades on the Trade Scalper here. Take for example, this Trade Scalper. I'll put this over here so we could see everything. And I'm going to add here the ATR just so I can see the expectation of each of these scalp trades. When you take a look at this target, can I really expect, because I'm using a 1-minute chart, it's different, not a 5-minute chart, can I really expect a point or 2 points or 8 ticks? I can't. I could only expect the market to move 2 ticks. So when you look at a 5-minute chart, it's different. It's based off a 5-minute time frame, 20 minutes, larger candles, larger pricing. When you look at a 1-minute chart, what you're looking at is a smaller target and a smaller stop. Especially when it comes to scalping, it happens to be a small target and a small stop. So looking at this here as 25.4875, this as the entry, what could I expect at the time this happens? I could expect 3 ticks. When the market is slower, I expect, again, 3 ticks, or I expect 2 ticks or 3 ticks. But when the market is too slow to trade, we also have to consider it's not worth trading if it's too slow to trade. So what is it too slow to trade on a 1-minute chart or when scalping? 1 tick. Whenever the market drops below 1 tick, this is now relevant. Just like usually when the market drops below 4 ticks, I say to you it's too slow to trade. On a 5-minute chart, it's too slow to trade when the market drops below 2 ticks. So in reality, we're only going for a tick. How can you trade for a tick? You're going to risk 3-4 ticks just to make 1 tick. That's not possible. The risk to reward ratio is upside down and you're going to get in trouble. So I don't want to take unnecessary risks. If I see the market is too slow, I don't want to trade. So for example, 25.50 quarter as the entry, I want to go long. What's my expectation? 2 ticks. My expectation is a 2-tick target. So I come here to the dome and I look at 25.50 quarter right here to buy it. But the ATR should be 2 ticks. So I come here and I say 2-tick scalping. So 25.50 quarter.
Order pending.
I want to go long at 25.50 quarter. When I get filled, I know exactly the target that I want is 2 ticks. And I also want to make sure that my stop isn't 5 points or 4 points or 3 points. It's got to be relative. You should never risk more than double what you're trying to make. So if the target is 2 ticks, the maximum risk should be 4. If the target is 3 ticks, the maximum risk should be 6. If the ATR is 4 ticks, the maximum risk should be 8. Then we can manage the trade with time, with proof. We can manage the trade when it hits your target and it doesn't get filled. You can do all these things, but more importantly, don't hold on to a losing trade. And if you don't get filled, look for the next trade. Don't chase it. Always be as specific as possible. Any questions? Now on the Atlas line, let me just put this here so I don't lose it. On the Atlas line,
Order canceled.
you're going to see a signal here to go long. So it's going to say go long in a moment. I'm almost certain it's going to say go long. And this is all taught in the live classes because I don't want to just follow software. I want to teach you why this works, how this is calculated. So this is going to say long in a few minutes or in a few minutes. So when this says long, you say to yourself, okay, I'm going long. What is my expectation? If you look at the ATR here on the 5-minute chart, it says 1.34, 5 ticks. So my expectation is 5 ticks. Then you say, what's my stop? What's my risk? What's my trade management? There's not any news at this time. News as 11 o'clock for the crude. So you're looking at all the possibilities. First, what could happen if the trade goes wrong? Second, what do I want to get out of the trade? And now you ask yourself, is the market possibly overbought or oversold? Sometimes the market could be overbought and oversold, which means you're entering as the last trader going long or the last trader as a seller, and there's no additional upside potential. So being overbought and oversold is always a problem. If you go long here, remember, it still has to go higher for you to be successful. It has to go 5 ticks for you to be successful. From here to here is 5 ticks. If this changes and the market gets smaller and slower as time progresses, no problem. So if you're long
Order filled.
and the goal is 5 ticks, which is here, 1, 2, 3, 4, 5 here, and put the stop over here. If this gets slower and slower and slower, this is adjusted like this as time progresses. If need be, adjust it again. But remember, after 4 candles, time-based stop, no target, no stop, cut the trade loose, get out of the trade. So I've given you a number of management methods when in a trade, both by using front running, by looking at the ATR and adjusting, by looking at price action, just missing your target, bringing it down, by touching your target and it misses it, and you are actually forcing it to fill you. So you're looking at a variety of ways to manage the trade. Never walk away because anything could happen. A lot of traders want to set and forget. This isn't the way trading should be. You should actually always be involved and look at it and stay involved. And the best way to close out a position is to click close. So if I was ready to take a profit, let's say that this is 20 minutes later and there's no profit, there's no stop, wherever the market happens to be, when you click close, what it does is it cancels the stop, it cancels the target. So these are pending orders waiting to fill you, but it also closes out your position and it clears out any pending orders you may have. So the best way to get out of a position is not by manually hitting the X or closing out your position by buying or selling to complete the round turn. It's by clicking close,
Order
because I
filled.
want to be sure that all of the trades and pending trades you may not even see. You may have some sell order
Order
way up
pending.
here that you can't even see. It's a price that happened early in the morning or the day prior. And if the market runs up there, this order still exists. So by clicking
Order canceled.
close, you will automatically clear out all the positions that are possibly still out there pending and really puts your mind at ease. All right, last thing, day traders, exit your position at the end of the day, because if you hold on to a position overnight, there's more margin. So your broker is going to require that you add more money for each position that you have open or outstanding. And they also treat, and I would definitely check with your broker on this, they treat the 2 sessions differently. The day session is treated separately when compared to the overnight, the Globex session, and the after hour session. However, they refer to it depending on your broker. So don't think that just because you're holding a trade overnight, that it's going to offset it if you have a sell. It'll treat it as two separate transactions, and you have to reconciliate it later in the day. You have to call your broker to make sure he does that. So when you hold on to a position overnight, make sure that it gets offset, not that you have one long overnight and one short overnight, because that's not always the way it works. Okay. Um, the next mentorship class begins in November. It includes the At the Open 2, software courses, blueprint, roadmap, Atlas line, lifetime for everything. Oh, I forgot the ATO. Somebody asked me about the ATO. Sorry, let me show you the ATO before we go. See what that looks like for today. So the At the Open 2 software, you have to make sure that the market open parameter you start off is in your time zone, and everything else I pretty much leave defaulted unless the trade chaser here you want to change the colors because it provides more than just one signal. And so the ATO long 25.50 for today is the entry to go long. Excellent. Okay, very good. Very good. Does anyone have any questions for me? Anything that I covered today? You got it, Carl. Thank you. Have a great day. Email me if you have any questions, if you're interested in joining up or interested in learning more about the products we offer. You can subscribe to our YouTube channel and check out the blog. The blog has great information. Very good. Okay, have a great day, everyone, and I'll talk to you soon. Take care now. Bye-bye. We have more videos available on how to trade the markets, including access to free software. Visit DayTradeToWin.com, check out the next mentorship class, and email us or call us with any questions you may have.